Yo, what's going on, guys? It's your boy Conquer FX, and welcome back to another YouTube video. If it's your first time on the channel, please show some love and leave a like on this video, subscribe to the channel, and click on the notification bell to get notified when I release new content. So, guys, in today's video, I'll be explaining supply and demand into detail. So, I'll be showing you the ABCs of which supply and demands to identify which ones work, which ones don't work. So yeah, guys, let's get into this video. So there are there are there are three criteria which we look for when basically we are talking about um, supply and demand. The first criteria would be it has to break structure. When we are talking about a level of supply or demand, we are talking about levels of supply and demand that break structure. Here's a nice example right over here. As you can see, price immediately after the banks got involved, it broke this previous high right over here. As you can see right over here, we had a break of structure. So yeah, number one is we want break of structure. Number two is high volume. When the banks get into when the banks get involved in the market, you will see heavy heavy movements of price, impulsive moves of price actions. That's when you know that the banks are involved and the banks did push up the market, simply because the banks do run the market. They are basically the wizard that runs the forex market. So yeah, guys, criteria number one is you want to see a break of structure. Number two, you want to see heavy impulsive movement. And then number three, you want to see shortly, how can I put this in a proper way? After the level of supply or demand has been created, you want to see imbalance in that market. So right over here, as you can see, we have a level of supply and it broke structure right over here. And see, criteria number one, we have it breaking structure. Criteria number two, after the level of supply was created, there's a huge amount of volume in the market. And criteria number three is you want to see imbalance. So basically, how do you identify imbalance? Imbalance is the space in between. How can I properly explain this? So basically, when we are talking about imbalance, we are talking about from this wick right over here up until this wick right over here. As you can see, right in between there over here, there is clean price movement. There is clean price movement. So that clean price movement is called imbalance. And once there is imbalance in the market has to reverse and correct that imbalance. So which gives you quite a some kind of a confirmation that if we have a level of supply right over here and we've got imbalance, price has to come back and close this imbalance, meaning we are gonna get tagged in our level of supply or our level of demand. So I just randomly went back with our replay tool. So basically, I will be showing you guys how to properly identify your levels of supply and demand and which ones I choose and why do I choose them. So overall, firstly, we're gonna start with understanding. Um, we're gonna start with understanding institutional order flow. So I did release a video on institutional order flow, So as we can, if you did watch that video, you can easily tell that the order flow in this market is bearish, and this was our major swing levels right over here. So we know where we want to get involved. So guys, if you didn't watch that video, that is a very important video. I know it's long, but it is long simply because it is an important video. I want you to go back and watch that video. So guys, yeah, institutional order flow, already we know that the order flow is bearish. So as I've explained in the previous video, it's 1, 2, we mark out the leg, that leg that pulls the market, that breaks structure and pushes the market down. We mark out that leg, and you want to look for levels of supply right over in the top half of the 50%. And as we can tell, this is our most significant uh, level of supply. Why? Shortly after that level of supply, we had rapid movement, which is part of the criterias, and we had a break of structure. So we have criteria number 1, the break of structure; criteria number 2, the rapid movement; criteria number 3, which is your imbalance. As you can see right over here, there is our imbalance. So yeah guys, and criteria number 4, I'm gonna get into it. I just want to show you guys a perfect example, because already by looking at this market, I can already tell criteria number 4 is what we talk about: liquidity. Liquidity basically is, it's money, just it's flowing money that is just there in the market waiting to get taken by the banks. And the banks do manipulate the market sometimes by generating that liquidity through retail traders. So what would happen is that if you are waiting to buy at a specific level, you'd realize that price would drop even further, taking out your stop loss, and then price would continue going up further. So in this market that we're looking at right now, this is our liquidity. This is our liquidity, simply because we had people entering the market right over here. We had people entering this market right over here, and this is a generation of liquidity. So once liquidity is generated, it gives you better confirmation that the price has to come and take that liquidity, and banks will get involved at the levels of supply and the levels of demand. So out of the 4 criteria which I've just spoken about, I hope that they make sense to you guys. Number 1 is you want to see break of structure. Number 2 is the rapid movement of price. Number 3, it's the imbalance. See, there's imbalance. Number 4 is liquidity, taking out liquidity. Now guys, liquidity is very important, because if you cannot identify the liquidity, which means you are the liquidity, and once you are the liquidity, you are likely to lose money. So now we have identified this level of supply, and I'm not going to go over into detail as to how to enter correctly, but as you can see, price reacts nicely in this level of supply, and as you can tell, now we are targeting to take out our previous lows right over here, and let us see what goes on. As you can see, price drops beautifully. And now I don't want this video to be long, but I do want to show you guys quite a few things. So the thing that I want to show you guys is that, as you can tell right over here, let me just lock this. As you can tell right over here, we have our remember in the previous video I spoke about uh, our change of character. So right over here we have our break of structure to the upside, and right over here now we have our change of character. Now our change of character basically is alignment. It's the market realigning to order flow. We're in a small bullish trend, but now order flow kicks in. The banks are now getting involved. They're realigning the market again, meaning we're about to get bearish and heavily bearish. So as you can see, now we have, as you can see over here, we have this level of supply that has pushed the market down, giving us our break of structure right over here. So this is the level whereby, so for you guys to see it like properly, let me just do this. We are targeting the lows all the way down there, but for you guys to properly see price action. So this is our level of supply right over here, which is broken structure, and we have another level which does break structure again. But why won't we actually want to mark out this level of supply? So basically, the reason why we don't want to mark out this level of supply is that if we refine our level of supply, you can tell that this is what we talk about when we speak of liquidity. Right over here, we have liquidity, guys, meaning the banks are manipulating the market, generating liquidity. So they want the retail traders to get involved and keep on selling. Now they also understand that once we are selling, we are looking to take out the previous highs, so they will be selling for a long term. Now what will happen is this. I want you to see this. Basically what's happening right now is we had our most recent break of structure. Why we don't mark out this level of supply is because basically at this level of supply you become the liquidity, simply because you are unable to identify liquidity. And let us see how the market pushes. So I'm gonna pause it right over there, guys. So you see what happened. What happened is that you get involved right over here, and when you get involved over here, basically your stop loss is right at the level whereby the banks are gonna get involved in the market. So you are targeting the previous lows. We have our break of structure right over here. Right over here we have our break of structure, and now the problem about identifying the wrong levels of supply, you identify a level of supply whereby you are the liquidity. So hence I say I give you 4 criteria which you have to look at when it comes to levels of supply and demand. Now when you're looking at a level of supply, it should at least have 3 of those criteria. As you can see on this one, we have movement, which is breaking structure, rapid movement, the impulsive move, and we have a bit of imbalance right over here. And we haven't, at this moment, as you can see, there was no generation of liquidity. But once price starts to get here, you can tell that okay, there's liquidity now. Retail traders have entered, pushing the market down. So that is your 4th criteria. And look at what happens. Price pulls back, it takes out everybody who took the sells right over here, all the retail traders. So if your level of supply was wrong, you got taken out with the liquidity, and price tapped in and immediately shot down. Now if you have mastered the art of identifying proper levels of supply and demand, you would have get triggered in right over here with a very tight stop loss targeting. So basically you'd be targeting the previous lows. You'd be targeting price right over here. This is where you'd be targeting. So you see guys, like right over here we have, yeah, so basically this is where you'd be targeting. Your first entry would have been here, and this is your second entry. It's important, guys, being having the skill to identify proper levels of supply and demand so that you do not become the liquidity and you get caught on the wrong side of the market. So as you can tell right over here, we have a BOS breakout structure, and I'm just going to pause it right over here to quickly explain a few things. We have a breakout structure, guys, and as I've said, here is our level of supply. Number one, it broke what? It broke structure. Number two, heavy, heavy, heavy impulsive movement to the downside. Number three, we have a lot of imbalance right over here. So, do we have liquidity? Not yet. Let us see how the market plays. So, you see, guys, we marked it up because we have three of the criteria. So, boom, we have. Let me show you. Now, we look at this. So basically now we haven't really tapped in, so this is some form of liquidity. Now if you can see on a smaller time frame, the 5-minute, 3-minute time frame, we have a move to the upside right over here. We have this. So now I took trades on this simply because of this level of let me show you. We took the trade right over here simply because of this level of demand right over here. So what the level of demand had is we had a break of structure. One, we had a crazy impulsive move to the upside. Two, and three, if you can look at it on the 15-minute chart, we had a lot of imbalance right over here. So I went back on the 15-minute chart. Now, as I always say, you mark the 50% and we got involved right over here, targeting our point of interest, which is the level of supply right over here. Now, this is how the market played out. This was a trade we took today, which is a Monday, the 8th of August. So guys, it is important being able to identify proper levels of supply and demand. You see, our TP was hit right over here. Now we are in our level of supply. Now we are following order flow. This was just a small move because we knew where we were going, but now we are looking for the entry which was going to give us our order flow. Now, as I've said, when we get to your level of supply or demand, if it was on a 30 minutes, you want to drop down to the 5 and 2-minute. If you are using TradingView, if you are using MT, the MetaTrader app, whether it's on your phone or on your laptop, I strongly suggest you use TradingView. Whether it's VIX, you just go to TradingView binary implementation and you'd have a better view. So now I was looking to get involved in our level of supply right over here. So now let me show you how we got involved in this trade. So as you can see right over here, we had our breakout structure to the upside. And that breakout structure was simply caused by this level. Oh no, sorry. That breakout structure was simply caused by let me just take it down to the 1-minute time frame. It was caused by this level of demand over here on the 1-minute time frame. Now, on the 1-minute time frame, now as you can see, a breakout structure to the upside, and now we have a change of character to the downside. Now this was the change of character to the downside. As you can see, guys, the price was moving up nicely, but now we are looking to take ourselves. So let me show you how we got involved in this trade. So boom, now price broke structure, giving us our change of character, confirming that now we are no longer bearish, we are no longer bullish, now we are looking to go bearish. Now when I looked over here, this is a 1 minute time frame, there were no levels of supply right over here, because I wanted to mark out initially this level, but my first initial level was over here, was right over here, because this was a level of supply. Now why didn't I want to mark this level, guys? It's simply understanding that this is what they call the M pattern. So this is a reversal pattern. Now as much as I don't trade retail concepts, I do understand that this is a very strong confirmation of price reversal. So this was a double top. Now the double top did appear in a level of interest which I was looking at, which was my supply zone, and I understand why I would actually consider the double top. So the level of supply that broke the structure right over here, there was a reason why I wouldn't mark it out and thinking price would come back over there. As you can see, we had pushed to the downside without any other bullish candlesticks. So I did mark out this level because our change of character was right over here, and now the trade was over here. And as you can see, guys, look at the amount of pips, look at the amount of pips right over here. We had room to risk, it allowed us, it gave us freedom to risk, to over risk. So basically we were able to risk quite a lot, because this was, the stop loss was initially 8 pips, and with lot size 1 we were only risking $80, and we managed to close 500 and not 500, 410, yeah, $410. So price we got tapped in right over there. We took the sales, and price just melted, and yeah, this was our Monday basically. Now this was, all of this was achievable simply because we know which levels of supply to get involved in and levels of demand to get involved in. Now guys, levels of supply and demand, they help you with quite a lot, because also your psychology improves, because you don't get involved in unnecessary trades. You're only getting involved in the trades which you know what you are looking for at that particular trade. So guys, as you can see right over here, we did close, and we just push the market. Yeah, so basically this is the current market movement right now. So yeah guys, that is how you identify proper supply and demand levels. I hope this video was very educational to you guys. Drop a like on the video, comment if you've got anything to say, and in the description I'll leave a link to my free Telegram channel whereby I share setups and signals on a daily basis. Thank you guys for watching, and I'll see you guys on the next YouTube video. Much love, peace out.